Welcome to the Market Huddle Plus. I'm Kevin Muir, and we have the great pleasure of having Paul Krake from View from the Peak back. Paul has been on the show before, and for those who don't know, he has had an illustrious career working at shops from Goldman to Caxton. Great to have you back, Paul.
Kev, thank you. You know, one of the signs that people are using ChatGPT in their daily life is the use of the word illustrious. Apparently, delve, and illustrious are the two of the words that people say. That's a dead giveaway.
Is that true? You're not just making that up?
No, sorry. Illustrious, I'm making up. Delve is not. Apparently, okay. Delve is the word that ChatGPT likes to use a lot.
All right. So I don't want to give away the fact that I'm writing it by using the AI. And actually, we're going to have a great discussion because Paul and I had a little debate before this a couple of weeks back because Paul is a much more bullish in terms of AI than I am. And he was actually asking for some pushback in terms of, okay, well, give me the negative case. And so we had some back and forth. And, we said, this is the kind of thing we should have on the show and we should talk about it. So let's just dive into it. AI, I'm a little bit of a skeptic. You're not. Tell me why I'm wrong.
So Kev, I'm actually in London at the moment, and I'm here working on a new business, which I won't get into, but it's in the capping orphaned oil wells, which is a scourge of methane leakage globally. And the reason I'm looking to do this business is because I think we can make a hell of a lot of money out of it. B, I think that it is a tremendous environmental benefit to stop methane leakage around the world. And C is I'm looking for an alternative because I don't believe my research business will exist in 3 to 5 years' time.
Why is that? Because of AI?
Because of AI. And, if I look at just to set the stage, I think the next 5 years are going to be 5 of the most incredible years in terms of economic transformation, portfolio returns, technological advancements that we will ever see. Because the use of ChatGPT and the derivatives thereof are going to be the most incredible enhancements to businesses that rely on businesses that are strategy focused. You might be like at McKinsey, whether you write a newsletter and research like I do, or you work at McKinsey. AI is going to be this incredible tool that is the scale of multiple analysts at your fingertips. I wrote a report over the weekend on global property markets, and I fully disclose I use ChatGPT a lot in my research process, and the amount of data that I was able to analyze and the concepts I was able to consume in I think it took me 6 to 8 hours on Saturday, 8 hours on Sunday to write this thing. It was remarkable. And it was the power of 3 or 4 analysts to be able to do this work. And the reality is there's always going to be, the roles for the folks that you talk to on the Market Huddle regularly, those macro strategists, those top-down analysts, they're always going to have people who will want to listen to what they say. But in terms of the ability for the human analyst to be able to produce content at a superior level to what an algorithm can produce, well, that over the next 3 to 5 years is going to go from a tremendous tool that we can to enhance our process to something that will overwhelm the process. And that's not just going to happen in the microcosm, which is the investment research world, but it happens to a geologist at Rio Tinto as Rio realizes that it can discover new copper deposits without the use of the 500 geologists or something like that Rio Tinto has. It's going to be the ability, we've heard about writing code. We've heard about, the ability to do drug trials algorithmically. These are the sort of things that are just going to be utterly transformational. And, if I think about what this means for investment returns or stock market performance more specifically, you think about this in a similar vein to we had back in 2002, we had 2 incredible forces that over the course of 7 years saw the profit share of GDP in the United States double. And those dual forces were the rise of China and the outsourcing of the supply chain to cheaper, more efficient marketplaces. And the combination of that with the commercialization of the internet, and whether that's selling airline tickets online, whether it's taking those orders, digitally sending those orders to China through web platforms, the rise, the beginning of the cloud, and all this sort of stuff, right? You had this incredible force that saw the doubling of the profit share of GDP over a 5-year period. So today we don't have China and the internet. Today we have AI and the rise of electrification, or the rise of cheap energy in the form of renewables and the like, which are going to take an ever greater percentage of global electricity production, which, given AI, given electrification of processes, has to double over the course of the next 25 years. So these two tailwinds are going to be just remarkable in terms of their profit generation. And I think what we're going to see over the course of the next 6 to 18 months. I was having a dinner recently with someone, and I don't know if it's 2 quarters or if it's 6 quarters, but it's going to happen where the world is going to transition from one that is laser focused on those companies that are the plumbing of AI, the Microsofts, Nvidias of the world, to name but a few, to the beneficiaries of AI. So whether that's healthcare, retail, financial services, research of all its forms, that those companies are going to show the supernormal profits as their productivity improvements go through the roof, as the Rio Tintos, the Boeings, the United Airlines, the Eli Lillys, etc., start to utilize this incredible tool. And that, I think, is going to last 5 years. Further than that, I don't know. Long term, I'm incredibly scared about what this does to Angus, my 17-year-old son, who's about to go to college next year. What does that mean for him? But for the next 5 years, I think it is going to be a economic miracle, a deflationary force, a productivity boom, a profit enhancer. And I think we're going to see the S&P trade 10,000 probably by 2030. And I've also said I think the Nikkei trades 80,000 around that time. And to achieve that, you only need 12% earnings growth in both those markets for those things to happen. If AI does what I think it could do, then 12% earnings growth is certainly not inconceivable.
Okay, lots to unpack there. Now, first of all, before we start, I want to say that Paul has been a Mag 7, or at least a large cap tech disciple for a while. And hats off to you, because you've been right. Like, let's just, you might not like it. You might be disappointed by the fact that all the only stocks that are going up seem to be Mag 7, but it's been the right call. So first, I just want to congratulate you on that, because people that are sitting around and saying, oh, it's not a real market, or it's all fake, or whatever. I'm like, the color of the dollars, or the dollars that you're going to make from that, is the same regardless of whether you like it or not.
Yeah, but look, the Mag 7, or I don't think of it in the framework of the Mag 7 per se, because I'm a massive Tesla bear long term. I just don't get it. I think about it slightly differently, that what we don't appreciate, whether you think Mag 7, whether you think, throw in companies like TSMC and ASML and, great international technology companies as well, is that, I have a very simple rule of investing, is that you want to invest in the world's best companies. And Microsoft is one of the world's best companies. And Nvidia rapidly has become one of the world's best companies. And the reason why you've had so much US outperformance over the course of the last many years now, is because if you do a list of the world's 20 best companies, right, and that list does change, right? So if we were having this conversation 10 years ago, Alibaba, Baidu, and Tencent would have been well and truly on your list, right? And I don't know if they make that list now, right? But you consistently, if you sit down and think, what are the world's best companies? Right? What are the world's best brands? Who makes the most money? You consistently get somewhere between 13 and 16 companies are domiciled in the United States, right?
Okay.
That's your reason for US equity outperformance, is because the best companies are here. They make the most money. They have the best products. Right. Because if you think truly about global brands, where do most of of global brands come from? Right? It's not Bayer. It's JP Morgan, it's Nike, it's these companies, right? So I think, and again, if you think about that through that lens, if the best technology companies in the world are domiciled here in the United States and they are in an unregulated environment effectively, there's no tech regulation in the United States compared to Europe and China, and they've been allowed to flourish and flourish globally, and they make a shit ton of money, and they're the world's best companies and the world's most profitable companies.
Okay, so you've been right on owning the world's quote unquote best companies. Now, the call that you're going from here is that it's going to change from, instead of us, participating in this land rush that is AI and buying the NVIDIAs and the Microsofts and the Googles and the people supplying the AI, your argument is that we're going to start to see the actual benefits, and in how that'll manifest itself is in improved profitability at actual companies. Is that correct?
Yeah. Now, I don't think it's a reason to sell Nvidia, because Nvidia is probably going to have, is going to have 30% earnings growth for years to come on the back of the scale of the processing power that we need to generate and to run these algorithms, right, and to run these LLMs. But look, we're going to start to see over time, and mate, trust me, I do not know when this starts. But what I do know is, well, let's look at the recent earnings season, right? So going into that earnings season, prior to the blowout numbers by Google and Microsoft, just after the employment cost index came out hot, stocks crapped out, and then then Alphabet and Microsoft came out that 4 p.m.
That's right, and they had the big
announced great earnings, and it skyrocketed from there, right?
Yeah.
Now, the reality is that earnings season wasn't overly great. I think I saw something today that outside the Mag 7, the S&P, the other S&P companies, their earnings are down 2% year on year. But you didn't really have any shockers out of technology or out of other companies, because they were hiding behind this notion of, what is my AI strategy? Right? How do I cut costs? How am I enhancing my production processes? How am I doing this? And at the end of the day, it was almost like these companies, they certainly, most S&P 500 companies have an AI strategy of some description. And the first way that will manifest itself is in cost cutting, right? Now,
but wait, can I interrupt there? Isn't the first actual part of that spending?
Well, yeah, they're spending now. They're starting to spend now, and they're going to be rewarded for spending, right? They're going to be rewarded for spending.
And isn't that what we're seeing? The fact is that maybe part of the reason these companies aren't having better earnings is because they're being forced to spend on AI.
Well, remember, man, if you're a user of these products, right? If you're Microsoft and you're spending $50 billion on rolling out with OpenAI, you're spending a lot of money. If you're buying these products, if you're implementing products around AI, it's not that expensive of a CapEx effort, right? It's like saying, I would say it's something comparable to saying, I'm going to get rid of my server room and take on the cloud.
Okay.
Right? Actually, from a CapEx standpoint, when you did that, you spent less money.
Right. You expensed it, and someone else is doing the CapEx for you.
Yeah,
and that's your argument, is that Microsoft and all these other ones, they're spending that money, and then everyone else is going to rent it from them.
100%.
Okay.
Yeah, 100%.
So therefore, the actual spending for the AI in terms of using it in the real world has not yet started. Or it's started, but it's not in a real big way.
Right. So think about a company like Apple, for example. A few months back, Apple was underperforming. People going, well, what's their AI strategy? Well, Apple's AI strategy is really simple. It's the same strategy they use with search, which is, it's cheaper I could build it. Apple could have built out its search. It could have spent $5 to $10 billion and build out a search network, or it could turn around to Google and say, Google, you're going to have a billion wealthy people around the world utilize your service. You can pay us $10 billion and put your search on our phone.
Right.
So Apple's strategy is actually to get paid to utilize its incredible distribution. And there's talk that they're going to use OpenAI, and there's going to be a Gemini app on their phone, all this sort of stuff. Microsoft and Google may pay Apple $10 to $15 billion each per year to have that on their phone. So Apple's strategy is to get paid to use someone else's AI.
Okay.
Pretty remarkable, right? It's a great. What a
For
great business model.
For sure. But let's talk about the other people that'll be using AI. Let's just take, for example, you use the Freeport McMoran, I think, in terms of them, outsourcing their engineering and using AI. Do you think that
Yeah,
that sort of stuff has started, or are they just starting to experiment with it?
The commercialization of this stuff is relatively new. I mean, ChatGPT's only been really available to the public for a little over a year.
Okay.
So, companies have not had the chance to do this, but, and again, this is going to be trial and error, an organic process. But, what is clear is that the ability for AI to do not just menial jobs, this is not like putting accountants out of work, right? But this is putting research analysts out of work. This is putting geologists out of work. You'll always need geologists, but those geologists will be using these incredible tools that will enhance their processes. And a Rio Tinto, a Freeport McMoran, a BHP, they're not going to need the geologists they had in the past if they can have customized tools that greatly enhance the process of exploration.
Okay. And so ultimately, the bet that you're making, or the assertion, is that these tools that have so far just been a lot of promise will actually live up to the hype and provide that sort of savings and the ability to get rid of staff in the way that is being talked about.
They are the ultimate productivity tool.
Okay. And so when we were talking about it, I think we came to the conclusion that I said, okay, so I'm not sure I agree with that. We'll see. I'm open to the idea that I might be wrong. I'm wrong all the time. And I thought, okay, how will it manifest itself? What will we see? And I came to the conclusion that ultimately this means layoffs, or at the very least, less hiring.
I can't, Kevin. I have been saying for 2 decades that this technology, the internet primarily, that this is the technology that will lead to the inevitability of the breaking of the cycle, that one creative technology that eradicates a sector. The historical process is, people found jobs elsewhere, right? And I've been saying for 2 decades that we are at that point where that won't occur. That will stop. And I've been wrong, right? Because we've got full employment, pretty close to full employment all over the world, effectively, right?
Right.
I do believe this is the case now, because you are replacing human intelligence, and at the end of the day, it's pretty hard to. Well, let's think of this sort of academically. If AI is smarter in terms of doing jobs than the current human employees, right? As a CEO, you are obliged to take that cost-cutting step. Now, I think over time, if these models, if these LLMs become superior in intelligence to the average worker, then the average worker doesn't have a chance. I think and we could, again, I don't want to go off spiral into some dystopian view of the world. Probably the only thing that Elon Musk and I have in common, it is scary, and the notion that this is going to lead to, well, people will find other jobs. So with the whole thing, there's a lot of caregivers apparently going to take jobs, Kev, because that's the one sector that people talk about. Right. Well, we'll need a lot of caregivers, right? And I'm sure, with all due respect to caregivers, if you're an analyst at JP Morgan and you've just been replaced and you're 28, you're not going to become a caregiver,
right? Okay, but that's kind of a longer term basis. And I think over the shorter run, like you said, you thought anywhere from 2 to 6 quarters, you're going to start to see improvement in the productivity. And ultimately, I guess what we're going to see is companies, non-AI companies, the companies that are be using this, their margins will increase, because in essence, they will be experiencing productivity and they will be able to do more with less.
100%. So think of it like, so a sector that is an obvious beneficiary is biotech, right? So to do drug trials is a long and onerous process, right? It takes years and years and years and years. There's ethical issues over placebos, and in cancer trials, it's a minefield. If you can start to do drug trials algorithmically because you have the processing power to look at all the options and all the side effects, right? Literally, there is the prospect of dropping the the studies time for new drugs down to months from years, right? That's one of the things that's just mind blowing that you can potentially do that, right? Yeah, between AI models sort of looking at different proteins are working together versus mapping the genome, all this sort of stuff. The advances in medicine in the next 5 years could be utterly remarkable. And anyone, if you know a biotech analyst, have a chat to them about this topic. They will be utterly giddy about the opportunity sets in this stuff
Now,
because you can do things in months that normally took years.
won't that be a rather unique implementation of AI in that it'll actually create a product, whereas most of the other things will just make increase productivity?
So I was mucking around on YouTube a couple of weeks ago, and I was listening to this guy talk about how product development may not need humans going forward. That you could actually start companies. Let's say I'm looking at my coffee table, and my Garmin watch is on the coffee table. But let's do something simple. So there's a pencil on the table. That an algorithm could design a pencil, legally start a company, fill out the forms to start a company, and send them in. Do that all online.
Yep.
Find a manufacturer in, let's say, the Philippines. Contact that distributor electronically. Take the pencils, distribute them on Amazon. And he said, and this person was saying, the technology in GPT-4 exists today for a company to be started without human involvement. Now, that's the design of a pencil. But if again, like there's loads of people out there who just make stuff in China and sell it on Amazon. We're at the stage now where that could be done without human involvement.
Okay,
Right.
here's
that scares the heck out of me.
Here's a pushback for you. If you rewind to the late 90s, the dot-com era, there was all sorts of talk about how the internet was going to change the world, yada, yada, yada. And all of it was correct. But at the same time, the amount of time that it took for those changes to occur actually was much longer than most people would have ever guessed. What about the idea that, you might be right, but maybe your 2 to 6 quarters should be really 2 to 6 years, or maybe even longer?
I think that the incremental gains will be quicker than what people think. Yeah. I think that scenario about producing goods without humans involved, that stuff could take longer to actually occur. But well, put it this way: the technology actually exists for a lot of these advancements to happen. Right. And that's why, you're hearing, S&P 500 company after S&P 500 company and companies abroad as well start to talk about what their AI strategy is going to be. And the reality is the first port of call for that, the low-hanging fruit, is cost cutting.
Okay.
Right. So I don't think that's incremental. I think some of the biggest shifts in terms of the job losses, the more dystopian stuff, I think that potentially could take longer. But the argument, look, I mean, if you go back to the conversation, the debate you and I were having, Kevin, our whole thing was about inflation. And this is where this becomes quite important. And you made this point very clearly. If I'm right, this is Schumpeter's dream, right? This is creative destruction, disinflation. Capitalism is a deflationary force, and this technology is the greatest deflationary force and productivity improver we've ever witnessed, right? And that deflation will hit us, if I'm right, in 2 to 6 quarters. If I'm right, right? If you're right, then we have to deal with inflation as an economic input and an investment input, maybe for longer, right? Because in my world, this inflationary pressures that we've seen, well, they disappear. That dissipates quickly. But if it does take longer, then there's more sort of macro headwinds related to prices than I would anticipate.
Okay, what worries you the most? Like, what keeps you up at night about your call?
About the call itself.
Yeah, like what and at what point would you start to get nervous to say, no, do you know what? This wasn't what I expected.
Mega cap tech has worked and worked incredibly well for a very, very long time, right? So what I'm describing to you, Kev, is a period where value outperforms growth. Now, if you look back since over the last 15 years, right, there has been 1 year, which was 2017, where value outperformed growth. And by value, the value is the Russell and emerging markets outperforming the NASDAQ, right? We've had 1 year in the last 15 years where that has happened in a rising tape.
Okay.
So it obviously happened in 2022, right? It happened in 2022 because tech got
Right.
hammered.
That's a down
right?
tape, though.
And everything was down,
Yeah,
right?
okay.
But in terms of markets were up and value outperformed one time in the last 15 years. For me, for what I'm saying to actually happen, you are bucking a 15-year trend. Look, value just doesn't outperform growth. Magnificent Seven, Mag 7 does well. Tech does well. Russell underperforms. EM, who cares? And we've
So
been
wait,
like that.
you honestly, so you think that whole notion that value outperforms growth over the long run is wrong?
Well, the numbers in the last 15 years, it hasn't happened.
Well, for sure, completely agree with you there. The question is this 15 years at a pause, or is this a change?
Well, I think it can be a change. So I think in a lot of ways it looks like 2002 to 2007, where you had the doubling the profit share of GDP over that period. And admittedly, you're still coming off the legacy of the bursting of the tech bubble in '99 and the quasi recession we had back in 2001. But from 2002 to 2007, you had this incredible performance of value where mining, materials, industrials all did well because of China. You had financials doing great, and consumer stocks did tremendously well. And tech struggled for a decade, effectively, right?
Okay.
And so, what you asked me, what keeps me up at night on that call?
Yeah.
It's in the value versus growth paradigm. It's a paradigm shift, right? And I'm not comfortable with that, right?
You're saying that this technology, the AI technology, will allow value to start outperforming because they will experience the benefits of this productivity.
Correct.
And you're uncomfortable because you've gone 14 years, long growth, doing great, and now all of a sudden you have to put on like a different tiger suit.
You got to put on a different suit, and it's Remember when Julian Robinson said value investing was dead in 1999?
Did he actually say he was dead?
Yeah,
I didn't.
Yeah.
I thought he just closed shop. I didn't realize he actually proclaimed it dead.
I think he sold his last share of American Airlines and said value investing is dead. I'm out of here.
Okay, so do you think we're at the Julian Robertson selling his last share of American Airlines? The equivalent, like the opposite.
I don't know, Kev. I don't know because again, let me be clear. Value may outperform growth, but there is no reason to sell Nvidia and Microsoft.
We just can't take that out of you, right? We can't beat that out of you.
They're providing the plumbing, right? They are providing the plumbing to this incredible economic force, right? So how many Copilot subscriptions is Microsoft going to sell in the next 3 years?
The question I have for you there, is there any price for those stocks that you would be like, oh, that's too much? Like, agreed. It's great business. It's doing awesome. Completely. I'm not going to dispute that. And it's not like the late 90s bubble, because those guys weren't making any money. These guys are actually making money. And there's a reason that those stocks have done so well. They've made just gobs and gobs of money. My question to you is there some valuation that you would say, oh, that's too much? Or would it just be like, I suspect the market is continually underestimating the potential for these guys to continue making money?
Kev, it's more the latter, because at the end of the day, I work on a theory of don't sell the world's best companies.
Okay.
And Nvidia is one of the world's best run companies. Microsoft is one of the world's best run companies. Alphabet is one of the world's best run companies. Right? So Now, they deserve a sizable premium. Now, I don't know if it's the premium that Nvidia currently has, or at Microsoft at what 35 times forward, something to that effect. I don't know, Kev. I wouldn't want to sell the world's best companies.
Okay, fair enough.
Even if they are expensive.
Talking about NVIDIA just quickly, I know you don't do geopolitics, but one of the things that our buddy Louis Vincent-Gave is highlighted, the fact that people will say you can't buy China. I can't buy China because they're going to invade Taiwan. And then they'll be like stuffed to the gills with NVIDIA. And he's like, this is a paradox that these two things can't exist together. Because your NVIDIA, if China invades Taiwan, your NVIDIA is not going to be worth much. I was wondering if you have any comments about that.
As you know, I followed China for a very, very long time. I think there's an extremely low probability of China ever invading Taiwan. So for me, that's a low risk. But look, I mean, and again, that's you've just described the premise of the CHIPS Act. Right. And the CHIPS Act was designed to hedge against exactly things like this, because the US Congress woke up one day and realized what we all knew is that the US doesn't make the product that it is most reliant on, which is semiconductors. It designs them and does a tremendous job at doing that, but the physical making of them, they have outsourced elsewhere.
Yeah.
And hence, there's a new plant was getting looked at Minneapolis, Minneapolis from AMD, and the CHIPS Act is going to spend a lot. They're going to spend a lot of money trying to get chips back to the United States. It's going to take a long time, and TSMC is going to remain the most strategically important company globally, or one of them. And TSMC is another company you'd never sell,
right?
Because it's the factory that makes the most important component of the biggest economic transition we've ever seen.
Well, now there's a mouthful. All right, let's talk a little bit about the changing framework of macro. You've been around for a long time. You've seen it from a lot of different chairs. Mega themes and how they're affecting a macro trader. Just give me your thoughts there.
So Matt, I think about this, a lot. And, if you think about sort of algorithmic investing and AI investing. And I think that AI investing is different from algorithmic investing because it is more predictive and takes on sectors of the hedge fund world in particular that never really had competition. I mean, AI is a legitimate threat to the pod model in many spaces. So if you trade Honeywell and GE for a living, right, and there are pods that do that sort of thing, right? How do you compete with an algorithm that is designed to focus exclusively on that, right? And that's all they do, and they have better information and better time to market and better speed than you ever will. How do you, as a human trader, compete with something that is smarter and faster than you, right?
Okay, so what's the answer?
I don't. Well, so I think a lot of these, and again, the pods do a lot of varying things. So that they're not going out of business. But fixed income RV is a good example of this, right? How do fixed income RV investors operate in that world, right? Or do the opportunities arb themselves away very quickly because you have greater computing power that can arbitrage a US 10-year bond versus a US 9-year bond, and they can take that spread out before we even have a chance to take advantage of it.
Doesn't it just get tighter and then something new comes? Someone thinks up something new?
Potentially, yeah, but in the world of arbitrage, that doesn't really happen, right? That arb is arb, and I think that, put it this way: the more computing power we throw at something, the less the arbitrage opportunities will be.
For sure, I completely agree. But at the same time, in my day, I did index arb, and that was, I bought futures and sold the stocks in the basket. And as that has evolved, it's evolved in.
You were the Toronto whale. I heard that was your nickname, wasn't it?
And so that's evolved. And like I just take, for example, let's just take option arbitrage, where originally, market makers would sell a stock or an index option and then delta hedge it, and then eventually they figured out that they could hedge it with different options and they could offset it. And now we've actually gotten to a point where they're offsetting index options with individual options in terms of the stocks that make up the index and doing the dispersion trade. Like, doesn't it just get more sophisticated?
I think so, and you've seen a lot of this stuff has had the rise of new products, right, has been a big part of that, right? So you've had zero options, and this sort of thing has all been has been something which is developed over time. But the reality is that the ability to trade short term is becoming more and more difficult.
Oh, I would
Right,
agree with there for sure.
so so intraday trading has gone the way of algorithms, and does this start just to get into a longer and longer duration time frame? Right, it's going to be hard to compete with, say, something like trading around earnings announcements. Right, can a trader know more than an algorithm that is designed to know everything about a company?
So
And again,
this is again your belief that AI and computing in general is going to get rid of people.
yeah,
Yeah.
and what this is, Kev, is that AI is a driver of beta, right? So stocks go up in that world. Credit gets tighter in that world because these companies are stronger and have healthier balance sheets and all this sort of stuff. It makes the alpha opportunities for traders that much more difficult. So again, whether this is a active versus passive, this is more arguments for passive versus active, right? Because it's just going to be harder to trade against this computing power than we've ever seen
Now, having
before.
said that,
Trades won't exist, and
sorry, I didn't
are
mean
they
to
going
interrupt, but
to
like passive versus active, if everyone goes passive, then it doesn't work anymore.
right? But we could be making that argument for 15 years, right?
Well, we
And
might already be there though, don't you think? Like, have you?
I think we're getting very close. I mean, look, I don't think it's any coincidence that we've seen a slowing in capital markets activity and a rise of passive investing. I think that there's a lot of, certainly on a cost adjusted standpoint. I mean, I know that clients that I've had or clients I've lost in recent years, it's all been for cost cutting around active management,
Right.
because their fees are getting squeezed and they're not raising the money that they used to.
Got it.
Right.
Okay, so
And look,
let's talk about one last thing before I let you go here. We've been talking a lot about AI, a lot about computers, and then you've touched briefly on the electrification of the grid of like, let's just take EVs and a wide variety of different things. To some extent, didn't this AI come at the worst possible time in terms of our kind of already like onerous demands on the electric network?
look, just look at the copper price, Kev, right?
Yeah.
Yeah, look, copper's booming. And look, I mean, I think that, look, whether it's related around around climate change or AI, there was a push towards not only sort of cleaning up the production of electricity, but electrifying industrial processes. Right? We've got to stop burning coal, and we need to find ways to produce steel through like cheaper, greener sources of energy, as an example, right? So not only have you got this incredible demand boost because of AI for electricity, but you've got EVs, and you've got the electrification of steel production and petrochemicals, and thousands of other industrial processes that are moving away from fossil fuels because of environmental and sustainability reasons. And at the end of the day, the electricity grid, particularly in North America, doesn't have the capability to deal with that, right?
And so
so you look at
wouldn't that actually be kind of the highest probability bet?
in terms of the
In terms of an investment, because like regardless of AI works or not, regardless of a wide variety of different factors, we're not going back to turning on more coal and giving up on electricity. We're headed to have more and more electricity. And so wouldn't that actually be the high probability bet that this is going to end up being much greater than we expect, the demand for the companies that are going to help that electrification process?
The only way, Kev, we can get to an electrified future, right, which is industrial processes, AI, all of it. So clean energy and an AI world, is we have to spend a lot of money digging stuff out of the ground to build stuff.
Okay.
Right. We need the electricity grid. Texas in the last 3 years has put on more wind and solar than the other 49 states combined.
Really?
right?
What?
Yeah,
Wow.
it's booming. So anyone who thinks Trump is going to wind back the Inflation Reduction Act is on crack, because Texas is a red state and Texas has been a huge beneficiary of the IRA.
Okay.
But you're 100% right. There's not software will play a role in this, but at the end of the day, this is all about infrastructure. It's all about upgrading the electricity grid, and that's a lot of aluminum and a lot of copper and a lot of cement and a lot of steel, right? So, I think that there's a lot to be said for the infrastructure that's required for electrification. Kev, that's the low-hanging fruit.
Right. And is it just like go by Freeport? Like, is that
it's go by Freeport? It's only diversified miners. It's the Rios and BHPs of the world, but it's also looking at Next Energy, these sorts of companies. Solar's going to boom, wind's going to boom. Jury's out for me on nuclear. I think it's a fantastic solution, but it does take a long time to build a nuclear reactor.
Okay, why is the jury out for you? Because a lot of people have kind of thought this is the only real long-term solution.
Because it takes years to build a nuclear reactor.
Does it take years to build because of political issues, or does it take years to build from just a physical point of view?
If you were to do a survey of 100 people, the sentiment towards nuclear has undeniably shifted, right? So most of those people would say nuclear is a good idea. And if you were then to tell those people that nuclear power plant is going to be built 25 kilometers from their home, they'd say, no way. So not in my backyard is a huge problem for the nuclear industry.
Yep.
Permitting takes a long time to get done. It's a really good solution that takes a long time to implement.
Okay, you're a little bit of an energy wizard here. Why don't we take an interim step and get off coal and use more nat gas?
We are. The short answer is we are. And that's happening globally, right? And remember that the Ukrainian war was the thing that sort of created that hiccup globally, right? Angela Merkel made her bet that Germany was going to make that transition to get away from coal and use gas as the transitional fuel as they went away from nuclear, and that was a great idea up until the time where Putin invaded Ukraine.
Right. But why
That is happening.
But Biden's not allowing any extra LNG exports. Like, why aren't we just pumping this everywhere? Like, to me, it makes no sense to have any coal running when you can be replacing it with nat gas. Am I wrong in that analysis?
No, you're not wrong at all. You're not wrong at all. But I would push back a little bit on. Well, sorry, there's an implication that Biden's not doing enough. U.S. produces a lot of nat gas. There's no shortages of nat gas.
Right, but they're not exporting it in the way they could.
They're not. And that's more for domestic consumption purposes.
Oh, you think he's just doing it to keep the price of gas low?
I think he's doing it to keep the price of gas low.
Okay.
Yeah.
Fair enough.
And obviously they don't want to be sending gas to China and to doing that sort of thing. But again, we need more LNG terminals in the United States.
That's what I'm saying. But my understanding, maybe I'm wrong, is that Biden is actually not okaying those.
His policies on energy are rather puritanical. And sort of miss the forest for the trees. Look, shutting down coal is difficult in coal states. Like, it's hard. Joe Manchin doesn't want. They're not going to shut down coal immediately in West Virginia, right? But I don't think nat gas is the problem. I don't think nat gas is the problem. Nat gas is an interim solution. I think it is being embraced.
Okay. All right. Paul, it's been great chatting with you. Why don't you tell us one last time before we go what your S&P and Nikkei targets were?
10,000 by 2030 on the S&P and 80,000 on the Nikkei by 2030.
I like it.
Kev, I'll give myself some time in 2030. I'll give myself a little bit of breathing room.
I like it. It's a bold call. For those who are interested in learning more about your work and what you do, how can they get in touch with you?
I don't do X or Twitter. They can send me an email at paul@viewfromthepeak.com.hk for Hong Kong.
Okay, that's terrific. Well, thanks for coming on, Paul. It's great to hear your views, and I love hearing the bold calls. We don't get enough of those.
Yes, that's Kev. Thanks so much, mate. Keep doing what you're doing. We love you for what you're doing, and thank you very, very much.
Thanks. Take care.